Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hey everybody, thanks for tuning in for this episode with Morad Askar. Remember, new shows are posted every Monday and Thursday. You can subscribe to the show on iTunes and YouTube. If you're enjoying the show, please leave a review on iTunes. Before I play today's interview for you, I want to give a shout out to the great sponsors of Futures Radio Show: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. To learn more about these sponsors and the important things they are doing for futures traders, be sure to click on their logos on our website. Today I spoke with head trader and managing director of Convergent Trading, Morad Askar. Morad and I began our conversation talking about the adjustments he makes when trading volatile markets. We talked about the importance of trade execution and how we both have ranges or zones of execution where we're not held by a single price of entry. We chatted about how a trader can go about determining their risk per trade, creating a record that they can build on. And last but not least, we discussed the mindset Morad has heading into a new trading year. Without further ado, let me take you right to the interview with Morad. Morad, thanks for joining me for our annual interview.
Thanks for having me on once again, 3 years in a row.
I mean, it's been 3 years in a row. You and I have kicked the new year off on Futures Radio Show. And every year you and I pick a theme to chat about. And this year, I want to discuss trading volatile markets, creating a record that people can build on, and the mindset that you have heading into a new year. So let's start off with trading volatile markets. And I know that I personally have some things that I do differently when markets get a little bit more volatile like they are now versus when they are a little bit slower. So is your approach to trading more volatile markets the same as when markets are slower, or is it different?
So I have to adjust. I'm a lot of what I do is driven statistically. So I know I'm keeping track of what I call rotations, or in this case, just because we're talking bigger picture, I'm just looking at what we would consider to be statistically normal in terms of day range, including the Globex or the extended trading hour session. And I'll pick on the ES because that's the most popular product that people trade. But if you look at the full Globex session for the last 110 days, going back to pre-October, the normal daily range for the full session is 41 points. With a statistical mode, meaning the most common daily range is 15 points. Now, why am I bringing this up? I want to just draw a comparison. Then I go a year ago for 110 days to look at the exact same period because of seasonalities and all that. The normal daily range with the same parameters is 16 points versus 41. 16 points. So we are moving on a daily basis. We're moving about 2.5 times more in terms of range. You could use an ATR and all that stuff. I generally don't like to use averages for this sort of stuff because the data set's not entirely normally distributed. But with that being said, so as a trader, I have to account for that. I can't go in, for example, let's say I scalp for 6 ticks of risk and, 12 or 14 ticks of targets, just a one lot scalper. Let's say that's what I'm doing. I can't sit here and use 6 tick risk in this sort of environment. And a lot of people do, believe it or not. And you just get chopped to pieces doing that. So the first thing you have to account for when trading with volatility, the first thing that I do is to be aware of what is the current range, normal range, and adjust both risk and my scale outs and targets. But keep the key element of this is to keep the same R factor, meaning to keep the same risk reward ratio. So if I normally trade with a 1.5 R factor, I gain 1.5 times my risk. That's my goal on average. Then I have to expand my stop and I have to expand my targets. I love volatility, by the way, because I kind of grew up during the dot-com thing, and it's just the number of opportunities. To me, with higher volatility, you have a lot more risk, but you also have a lot more opportunity to do something with it, as long as you take the time to align yourself with the market. I should speak about myself, but it's like playing, for me, it's like replaying the market. It's like doing a market replay at 4 times speed. I find that it's easier to see what its intent is. I can see the bursts. I can see it flagging. I can see the next burst out. It's just much easier. But if you're trading a small account, if you're trading $5,000, $10,000, $15,000 account, there's significantly more risk to someone who's trying to trade the same way. So for that, I would say that, again, you have to adjust for the risk, adjust your reward, but you can also afford to be very, very picky. A trader can now pass on the kind of iffy setups that they may normally take. You can be a lot more picky because in a given day on normal volatility, say a year ago, I might get 4 setups a day. I'm a day trader. I might get 4 setups a day. Nowadays, I might get 16 or 20. And now I can just shed off the ones that are kind of meh and really focus in on the ones that show, good exhaustion and moves, and then trading with the bigger trend, that sort of stuff. So I find that it's just much easier to be selective because we do get that many opportunities. The other thing is, man, over the last 2 months, I've had so many people come and say how they finally felt like they made the turn and they could read the market, and then they got the supremacy bug, right? They figured it out. And all of a sudden I just did a trader intervention with a guy last week at a Convergent where he ran up in a live account. He ran up his account from about $5,000 to about $30,000 in 20 days. These, verified trades, and proceeded to lose $26,000 in one day. This is the kind of environment that can do that, where all of a sudden you're forgetting your risk parameters, you're piling on, you're taking excessive risk, and then one trade not working costs all of the effort that's been made over the last month. So with volatility, again, more risk, more opportunity, can afford to be picky, keep your parameters steady in terms of risk reward. And if you trade a smaller account, it's best to just sit out the first hour.
I love a lot of what you said, and something for me that I have learned when trading volatile markets like this is, number one, I expand my ranges of execution. I've talked about this many times. People that know me know that I execute in a range of execution. I don't enter in at one price. So what I do is I look at what's happening within the primary trend. And I think this actually goes for not only for more volatile markets, but for bull or bear markets. And right now with us trading in a bear market, I look at the long opportunities to be less interesting at my price of entry. So I try to scale in at or below where I think is a good place to get in. And I'm actually more aggressive on my scales on short entries on where I think there's going to be resistance. And that is purely because I am trying to take more advantage of the down moves. So I want to be in quicker and near the price of entry that my strategy has given me. And I'm less interested in taking a long right at my price of entry because the opportunities are coming in closer to my stops. So I could be patient and wait to trade when we get, I think that, let's call it that slippage, when we get that extra move lower, and then we get near my area where I think that the market is going to prove me wrong for being long, and I'll step in just in front of that area to try and minimize my risk. Are you doing similar things to that?
Well, I'm definitely making an adjustment now. I'm disappointed that you've been trading for 19 years and you're not just identifying a specific level to get in at and just make bank. That you're trading in ranges, because everything out there just says that you should be getting in at a specific level. No, I trade zones, right? I have this thing called stock zones. And I'm trading in zones, and I use order flow. Now, I'm a much shorter time frame trader than you are, and defining time frame is really key to any discussion. I'm an intraday trader. I don't hold anything past the pit close. I'm trading rotations, but I am doing the same thing in that with more volatility, I have to, my scale-ins have to be much wider. Again, 2.5 to 3 times currently what I would normally do because of the expanded range. I have to respond to the volatility of the market in every way. So my entire plan has to change. Technically, my net asset value of my account has to change to compensate for the higher risk, but I manage that by just trading smaller, right? So instead of trading a full unit, I'll trade a quarter of a unit because there's 4 times the volatility to keep all things constant. But the scale-ins are wider. I do press the shorts a lot more. I do take a look at, because I'm not a swing trader, and I don't define the market in terms of it's in a bear market or a bull market, because I come in with scenarios for each. Again, I'm intraday. So I'm looking at what's happening inside of these scenarios. And if my scenarios say the better scenario, the higher probability scenarios to the short side, then I do press the short trades a lot more than I do the long trades. The long trades are very short in duration. Most of the time I don't even scale into those. I just enter, I give it a wider stop, and then look for kind of an exhaustion rally. And I'm looking to do that on a very, very short-term basis. But then if my scenario says, look to the short side, look for a pop-up like yesterday, look for a pop-up and sell it, then I'm looking to press the short side. I'm looking to scale in as close to my stop-out area as possible to get as efficient an entry as possible. So I think we're doing the same thing. It just makes sense. You want to keep your risk as tight as possible without being in the noise, having your stop in the noise. And scaling, by the way, in my opinion, is an advanced way to trade. I would not recommend scaling into anyone who finds themselves trading emotionally or turning a scalp into an intraday trade, into a swing trade, into an option hedge trade. You get that a lot. You really need to have your discipline right and have a plan for scaling. I don't think we're advocating to move from trading the way someone who's listening is doing to scaling just haphazardly. You need to know I'm scaling in, I'm improving my average, and my risk based on my average after I've scaled in my whole unit is still reasonable compared to my account size.
Yeah, people on Twitter hear me say it's all about execution all the time. And of course, I say it on this show as well. But those are just the things that you and I just talked about that have nothing to do with strategy, but you and I mentally are preparing ourselves for how we're going to execute our strategy. And so I just want everybody to understand that's what I mean by getting better at execution. And I did not trade that way at the beginning of my career. It took me years, and of course I've evolved. I'm not nearly as active as I once was, but my skill set that I've learned over the years from when I was a very active scalper to even now, which I consider myself, I'm still intraday, but I'm not scalping anymore. I still use that same skill set of execution to help me execute my strategy. And I know that you feel the same way, Morad, that when people talk to us about choosing a strategy that best suits them, when they finally find it, then they have to learn how to execute it, right? It's not black and white.
You know, you might want to refill your coffee so we can talk for the next 2 hours about execution. Because that is such a big topic, and it's confusing, and there's a lot more emphasis. In my experience, I've been online for about 10 years. And it's all about what was the setup? Why'd you get short? Blah, blah, blah.
Yeah.
And I can tell you that the way you execute your trade management, the way you determine the risk on the trade, the way you execute the trade, and the way we manage, in other words, what's your trade management scheme? Are you scaling in, scaling out, all in, all out, whatever it is, and what's the distance, how you manage that can make or break your edge, no matter how good of an edge there is. In fact, I believe a lot of my edge is execution. Just no hesitation. I don't have any attachment to the last trade. The last trade is just rolls. It's just a drop in the bucket. You just got to move on and look to the next one. That's a big, big, big topic that's difficult for people to address. It's like somebody who wants to learn to play baseball, and now you're talking about how to read the ball mid-flight and swing a bat. It's a very nuanced discussion, but it's where contact is made with the market, So 100% what you're saying.
Yeah, don't worry, everybody. We're going to do a full show on execution, you and I, at a different date. But I want to talk about something that I think relates to execution before we get into journaling. Is something that you and I were asked, along with a few other traders, on Twitter the other day about determining a risk per trade. Since we've already been talking a lot about how you and I are looking at scales and how we're going about execution, talk to us about how you determine your risk per trade.
Okay, this is a common question. It's a really important one. At the end of the day, it's how you manage risk that makes or breaks you as a trader, I believe. How do you determine risk? So there are a lot of factors that go into that. We'll start, from the macro perspective. What is your risk tolerance as a trader? What's my risk tolerance? Most people identify themselves as very risk averse, meaning they're very risk shy. So you have to have, because this is a leveraged product, you have to have a high tolerance for risk to trade futures, because there's a significant amount of risk. That's why it's not suitable for everybody. But so you have to kind of know yourself coming in. The second thing is the money you're trading your money? Is it somebody else's money, which I've traded in the past, and it puts a lot more pressure. Or is it, and also how much money is there? In a perfect world, we don't want to risk more than maybe 1% per trade, 1% of your account value per trade. But to a lot of people, 1% isn't even a point in the S&Ps or the 10 years or whatever. It's very difficult to judge that. So for me personally, I look at the risk of ruin equation. This is all like Van Tharp type stuff, where we're really looking at, if I got into a bad streak, say 12 trades in a row that didn't work, how much does that hamper my ability to continue to take the 13th trade? Not only financially, but also emotionally. I'm seeing that I'm just getting run over. Everything I'm doing, I feel like I'm doing everything right, but I'm getting run over. What is it going to take for me to take that 13th trade? So you want to keep that to a minimum. The more you risk, the more one risks per trade, the higher the risk of ruin becomes. We want to keep that to about 1%. A rule of thumb that I like to use is the exchange margin that's put out by the CME, for example, is not some number that some person just kind of says, okay, let's make the initial margin on ES $6,600. They don't just pull that out of a hat. That number is a statistical number. It's based on how far one contract can go before settlement on I think on a 3 sigma basis or something like that. So use that number. So, you want to be really risk aware, and you have a pretty substantial account, trade one contract per margin requirement, per initial margin requirement, 6,600 in ES and so on. You can look those up on the CME site. Worst case, I think for most traders, is trading one contract for half of the margin. So don't trade more than one contract in ES for every $3,300 you have in an account in terms of the current margin requirement. Don't go below that. I believe that it's very imprudent to drop to $500 margins or anything like that. I think those should be regulated out. They should not be permitted at all. So that's one way to kind of keep yourself from really blowing up. The best way to deal with risk is to be well funded and then to create a very clear outline of what your risk plan is. It's something you kind of want to have in front of you in large font. Hey, 2 trades, 3 trades in a row, and I have to stop for the day. 3 losing days in a row, I'm done for the week, that sort of stuff. You need to have some parameters, but determining risk is a factor of account size, risk tolerance, time frame. If I was trading like Anthony here, who's you're more of a swing guy, right? You're looking at multiple days.
No, I don't trade multiple days. I trade intraday, but for me, I pick one direction after the first hour, and I trade actively in that direction.
Got it.
So that's more of how I trade these days. Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account.
Yeah, so for your time frame, you might, I think the Ultra Bond is your favorite product.
Yeah, the 10-year Ultra is my favorite right now.
Yeah, I mean, for your product, you might have a huge stop that's intolerable for me. So your time frame is bigger than mine, whereas I might have a time frame that is so small that I can afford a 4-point stop per contract or something like that. So the time frame really is important in terms of determining risk, in my opinion.
Yeah, no, I agree with you. And something that I do, not to, like I said, we could throw a wrench in this and go another way, is I trade around a core position. So that's what happens with me a lot is I'll pick one direction that I want to trade in for that time frame throughout the rest of the day, and then I'll trade around that. So I'm basically managing 2 trades at once. Not to, like I said, I don't.
That's very advanced stuff.
Yeah, I don't want to. We don't want to get there.
It to anyone who's just starting out.
And let's move on and talk about creating a record that you can build on, journaling with purpose. Because in my opinion, there's nothing worse than a trader doing something that they're not going to use to help themselves get better. I mean, why even waste your time? So Morad, talk to us about how you journal and how you use journaling to get better at trading.
So the first thing I have to say is that most of the traders listening know that they should keep a record. They should keep a journal, right? But my experience, again, has been that most traders that I've interfaced with are not really keeping an actionable journal. And by that, I mean that they're keeping more of a running diary. I don't know if that's a good word for it, but it's kind of like a dear diary. Today I'm feeling pretty good. The market has done this, and I saw this, and then the FOMC did that, so I got short, and that's more of a diary. Really, if you're not keeping a journal, a trader is putting themselves in a position where they're likely to not learn whatever they need to learn to make the turn. I didn't mean for that to rhyme, but it does. And it's just that we just go in circles, right? So think of any professional doing anything. There's a record of their performance. There's a scrutinizing part of the day that happens outside of market hours on that performance. There's a constant seek and destroy mission that is dedicated and focused to eliminating the errors that are being done. And errors could be things like I chased a trade that was way outside my parameters. I passed on a trade that I had planned and had set up. Those are errors. I got long when I should have gotten short. Those are areas that must be eliminated. And it's the errors that are eating our lunch as traders. It's just this repetition of the same error. Waited for the trade, got long, it went in my direction, 6 ticks, and it came back to break even, went against me 4 ticks, came back to break even. I got out, scratched the trade, felt better about myself, and then it ripped 28 ticks in my direction. Well, that's a big error, and the cost of that error is 28 ticks. Track that. So what do I put in a journal? I actually keep 2 things. I keep a trade log. Okay, so this is a simple thing. You can copy paste it into a spreadsheet from your platform or download it. So every day you're downloading your trades. And I go through the trades 1 through X, and they have a number. And I compute on a daily basis the performance metrics on those trades. I have a tool that does this for me, but we want to know things like percent win, percent loss, how much did you win, to compute the average win, how much did you lose to compute the average loss, average size loss in ticks. I don't use dollars. And then to get an expected value or an expectancy, how often have I scaled and stopped? How often have I stopped without any scale outs? Took a full stop. What percentage of my trades are doing that? If I find that I'm getting scale outs too often, it means I'm trading too tight. I need to expand my targets. I need to take more out of the market. And those metrics keep track of that. On a separate document, I'm keeping a journal. And this journal refers to each trade by number, and it sets up what the trade is. Okay, the trade is market broke out of range, pushed into multiple confluence resistance, failed to break through, started rotating back down, on the pullback, got short. Okay, you can call that setup whatever you want. And entry is such and such, exit is such and such. And then what you're doing next to that, the really important part is to say, how did the process work? So trading is about process, it's not about P&L. I know that it seems like it is, but the purchases and sales and the ensuing P&L and all of that is important, and we tend to measure ourselves with that. But I'm going to tell you, after backing multiple traders, after going through multiple rough patches and relearning myself, it's really the process that pays. And so if it's the process that pays, you have to make sure that you're following your process and your execution is as perfect as it can possibly be. So if that's all the energy that you're putting into trading is focused on how well you're actually executing, if there's an edge, if however your approach is, and I think finding a technical edge is not that hard, if the edge is there, it'll show up. This is why people do well in sim, blow up live. And so the part of the journal that's really important is, how did the trade go? So you want to grade the execution of the trade. And then the next most important part is, what are you doing to improve this? If it's less than your expectation, what is the action item? That's what a journal needs to tell us. It's not a running diary of what's happening and when you took a break and all that stuff. You can have that as well. That's fine if you find something useful in it. But what I find useful is the ability to go through my journal, cross-reference my trade log to see what trade that was, and to see that, man, I had planned to hold this from 2580 or 2600 to 2550, and I got out for 4 ticks. Why? So that goes in my journal. How was the execution process? How did I manage the trade? And what action item do I need to take to improve this? And it's that column with the action items is my focus. And that would be the focus for anybody I'm backing. This is a recurring problem. This is like almost a cancer on your trading. Pardon the term, but it's something that is slowly sapping away your ability to see better results. And what we notice for traders that do this is it's just, again, same error, same outcome, same action item. And then that becomes the goal. The goal for next week, now the week is over, the goal for next week is to shoot for better metrics. So we know what our metrics are. We shoot for something better. That helps us, first and foremost, it helps us eliminate crappy trades. When we have goals, we start to pass on stuff that just we know isn't going to get us to that goal. It acts as a filter for our future performance. And we have a goal in terms of ticks, expectancy, whatever it is we want for the next week, but also, and we're going to focus on this particular issue that keeps turning up in a journal. And where's the journal really pay off? It doesn't pay off when you're making good money every day. You're killing it. You're in the flow. You're trading with the flow. The market's paying you for your effort. A journal really matters when you run into that really terrible streak. I call them a rough patch. And that's the journal is what you pull up and go through the process that got you to the space where you're in alignment with the market again. A journal is a key piece or key weapon in our arsenal against the constant random change that occurs in the market. I hope that makes sense.
No, it does. Take us through the process of what you're using for software to journal your trades. And when you're journaling, are you doing it right when you're done trading? Are you writing notes while you're trading? Talk us through that a little bit.
So I started out with a spreadsheet that I created, and I called it for myself and my traders. We used to take the fills from TT's XTrader and take the fill window, and we used to copy and paste it into the spreadsheet, and it would compute all this stuff. It could be as simple as that. Could be hand done, although I wouldn't recommend it. The spreadsheet is a perfect tool for this. Remember, I used to scalp a lot, 3,000 sides a day, so you couldn't do it by hand. I don't trade that way anymore. But I continue to do it electronically. The software that I use for the trade metrics is a product called a Trade Analyzer. And it pulls the trades right off of the clearing firm server, so I don't have to enter anything, and it computes historically what I've done, and it pulls these metrics in, and I can export that information to a spreadsheet if I want to manipulate it a little more or extract more information out of it. The journal, though, is old school for me. I use a product called Evernote. You could use OneNote. And the reason I do it electronically as opposed to on a piece of paper, and I used to do it on a piece of paper, the reason I do it electronically is because electronically I can do a quick search. Like I can hit Control F and find some word I've used in my journal or something in my journal, and it'll go back and it'll scan right through and tell me where this word shows up. And so I keep it electronically that way. And in terms of whether I journal while I'm trading or after, I log, so that the trade log takes care of itself. I don't have to do anything there because that's automated. But the journal itself is done at the end of each trade. It is incredibly rare, unless I'm scalping actively, which is what I do in crude. But in the ES and other products, I have structure. It is really incredibly rare that I exit a trade and then immediately some legitimate setup shows up like seconds apart. There's usually, a few minutes to maybe even a couple of hours before the next real trade shows up, or predefined trade shows up. And so it gives me time to as fresh as possible at the time to jot down, entered short, order flow looked iffy, held it too long, stopped out, should have responded more quickly to XYZ, to the fact that delta is increasing and I'm short or something like that. And then the action item can be done at the time. And oftentimes I like to do it at the time when I'm journaling the trade while I'm trading. But sometimes I'll do it afterwards if I can't come up with a real action item. But the action item is usually trend continues to be down, should have held short, need to focus on the bigger trend. Keep an eye on that 15-minute or 60-minute chart more closely. That's my action item. So I do it as I'm running through because it's just fresh. If I go through and I have 15, 20, 30 trades, it's hard for me to come back at the end of the day and go, trade number one, what happened there? I have the time in between trades. And to be honest with you, especially on stop outs, I need that break. I just psychologically need that gap so that when I refocus, it's almost like I'm looking at it with fresh eyes, with a renewed drive to not do what I just did again if it didn't work out.
Can you give us an example of something that you learned from your journaling that helped you become a better trader?
Ooh, that's a really good question. There's a lot. Mostly when I'm running through rough patches, and my rough patches occur rollover week, generally summer. The thing I learn is the thing I consistently fall into is I will lose patience and I will somehow see more trades in the session while I'm in the middle of trading than really existed. So my journal will then get busy. My trade log gets busy. The volatility is compressed, the market's sideways, but here I am trading 2-3 times. And I can see that I'm inventing trades as opposed to just responding to what I should be looking for. Look, I took a short in this chop, got stopped, took a short again, got stopped, and there it is. I took another short. Why am I taking another short? Nothing has changed. It's still in the same range. It's hard for me to sometimes see that when I'm paying too close attention to what's going on in terms of order flow and I'm not looking at the bigger picture. That would not occur to me if I didn't see 3 lines in a row saying that there was a stop out and seeing the same direction and seeing the same action being taken again and again. So the biggest thing the journal does for me is it just really magnifies my errors. It tells me, look, your mind likes to my mind likes to massage information. There's a confirmation bias sometimes. Sometimes I like to forget stupid things that I've done. The journal doesn't allow that. It reminds me over a larger data set that there's a pattern here. And over the last 2 days, let's say, for example, over the last 2 days where I haven't been doing well, I've just been going short or I've been going long. I've been buying dips. And I can see it in the journal, really obvious. The longs are green, the shorts are maroon on there, and I can see, long, stop, long, stop, long, stop. And I'm telling myself what I should be doing, but I'm keep repeating the same problem again. And that's that cycle that we get into where we're not really adjusting. We're not getting into from our journal what the action item needs to be. What is the thing you need to focus on? That's the biggest thing I learned from it.
Yeah, very similar to me. And back at the beginning, I talked about how I trade bear markets different than I trade bull markets. And what I noticed in my journal was in bear markets, I was taking way more longs, and in bull markets, I was taking way more shorts. And when I look back at that over a course, over a period of time, I was like, this just absolutely makes 0 cents, right? And also I was noticing that I was getting in all of these trades going against the grain right at entry. And I would be, a lot of times, some of my biggest positions, some of my most aggressive positions will be going against primary trend. Now, mind you, I was trading intraday, so primary trend I felt wasn't as big of a deal to me. But over time, what took me, I think, years to figure this out was the simple act of identify longer term trend. Don't be in a hurry. Like right now, I consider this bear market trading. Don't be in a hurry to take the first long setup, because you're going to get a lot of opportunities to get long in a market that is trending lower. So nibble in and trade closer to where you think you're going to be wrong in the position. Trade closer to my stop. This way I could get nicked a few times for being wrong long, still trading small, going against the grain. And when we get a short opportunity, make sure I'm in. Make sure that I'm in a full position because I'm going with the grain. And once again, just the simplest thing, I learned how to trade bull markets better and bear markets better. And I learned that from my journaling. Let's talk about putting a year behind us and what we learned from that year. I mean, 2018 is about to close out. You and I were talking earlier. We couldn't believe how fast this year went by. And throughout the year, we basically just put our head down and we're always trying to tweak what we're doing throughout the year. But at the end of the year, I really like to see what I did well and what I did not so well and how I can improve the next year. How do you think a trader should look back at their year and, similar to journaling, what they can do to become a better trader the next year?
This is my favorite time of year. This is a time of year where things slow down enough for us to have a good look at ourselves. Like I spend a lot of time aggregating information. I'm taking off on Friday and I'll be gone a portion of next week. And I'm taking my laptop with me to go and aggregate my trade log and to aggregate my journal and see where I started versus where I finished. Sometimes habits creep in that I did not become aware of until I've gone through this process. But in the end, just like a CEO running a blue chip corporation, you need a plan for next year. You need something that a strategy, some imperatives, and maybe even some tactical plans on what your goals are going to be next year, what my goals need to be next year, and how I'm going to achieve that. So overall, I think the tides have turned a little bit in the market. It's not trading the same. It used to be, the market used to trade like a beach ball that's being pushed underwater and it just loves to pop right back up, right? That's an analogy from a Twitter friend that I have. And it's very apropos for this rally. We know, now disclaimer, I'm not an analyst, but we know that this bull run has been going for a record period of time. And I think things are changing. I think this volatility is likely to be here for some time, as all participants in the market are in a position where they have to move money or protect money. And so does that mean that we should sell every pop up like today, or tomorrow or the day after? Every time the market pops up, we want to sell it? That's not really the plan. We still have to follow our plan. But it's more about, hey, I'm taking stock of what we've done this year, where we are now, and I'm aware of what's out there. This has been an incredibly news-driven year. Holy cow! Between the North Korea thing, the Yemen problem, the OPEC stuff, the trade war with China, the trade war with Mexico and Canada, the tariffs, just a lot of noise this year, a lot of politically driven action this year. We want to take stock of all that, and then we want to look at what has our performance been and what it needs to be for next year and what areas need to improve. And that ties in with the journal discussion we just had from a few minutes ago. So get our mind around what it is that we have done. What are we looking at going forward? How is this additional volatility and risk going to impact our trading? Have a clear idea of what our goals are. You have to be accountable for what you did wrong, what you did right. You need to have very good clarity on what areas, personal areas, it could be things that are, it's just as important to handle these issues, your edge and your goals outside of trading as it is in trading. Did you let I let my health go a little bit this year. I'm not working out as often. I have a newborn that arrived in March and kind of threw a wrench. That life changed through a wrench and things. We launched Convergent trading. That was at the same time as my newborn. It was like having twins. It was really intense. So a lot of things kind of fell off that need to get back on. My meditation is inconsistent. That sort of stuff I need to take good accounting for. And the most important part of all of that is to distill that into what the process is going to be for next year to get those results. So first we need to define what we're after, and then define what the process is going to be. This coming year, I'm going to switch to this, go from 15-minute charts to determine the trend for the day to 60-minute charts because I need a bigger picture because of the volatility or whatever that change might need to be. The key thing, though, focus on process. It's really important. I put this meme out there last week or 2 weeks ago, and I said under Futures Trader 71 on Twitter, and I said every chart, line, statistical probability come up with, sound that you add to your trading platform, click, or any action emanating from your effort as a trader has to be directed at perfecting execution. Let's call 2019 the year of execution. It's the year where we perfect our execution. So if it isn't there, if whatever effort you're making, whatever tool you're adding to your arsenal, whatever piece of software that you're buying, whatever course you're buying, if it's not pointing you to, if it's not supporting flawless execution for next year, then it's pointless. It really is. You're adding to your arsenal something that isn't really going to improve your end product. And your end product is not your P&L, by the way. It's your process and execution. It's how well you execute your plan on a daily basis. This is where the mindset needs to be for next year. In the end, we could all be experts on the Ultra Bond. We can all be experts on the ES in this 1 minute time frame. We could be the best tick chart reader in the world. But if we're not executing off of it flawlessly, whatever that process is, whatever that tool is, you could be a fibber or whatever it is, then it's really you're wasting time. And losing money is one thing. Money comes and goes. Losing time, that's the biggest resource that we have, that we're born with, that we can never get back. So make this the year where every effort we make is about executing better. And hopefully, my expectation would be better results, better overall P&L, more happiness in terms of how well you did in the market, more return on our effort. That's what the mindset should be for next year, in my opinion.
Very well said, Morad. Excellent stuff as usual. It's always great to kick off every new year with you on Futures Radio Show. Where can people find you on Twitter, and give us a website to check out?
I'm on Twitter under the handle Futures Trader 71. I'm also on YouTube. I do a Trader Bite, a pre-market, free to everybody. Been doing it for 5 years now, maybe. Trader Bite every morning at 9 o'clock Eastern. You can find that on YouTube. Just go to YouTube, search for Futures Trader 71. My focus currently is building Convergent trading. You can find that at convergenttrading.com. This is just a virtual online prop type of environment where the focus is to help traders focus on trading on a professional level. So it's about community, and then there's training, and there are webinars that I do twice a week and things like that. And it's a subscription-based service, but that's what I'm looking to build. I'm looking to focus on that group of people.
Morad, thanks again for coming on Futures Radio Show.
Thanks for having me.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.